afternoon, everyone. We're Team Morpheus. Please follow us into the matrix. Let's dig deep into the collapse of long-term capital management. This is the order we will talk today. The first is overview. We will cover risks LTCM exposed and the crisis they went through. And then we have governance, which will look into the details of risk governance structure. At last, we have stress test, which apply to current market environment and related counterparties traits. Well, before we get into LTCM's risks and crisis, let's have a quick review on LTCM. Well, LTCM was founded on 1994. At the first 3 years, they did pretty well. But when Russian Asian financial crisis hit, the fund bled 83% in equity and ended up getting liquidated. LTCM mainly focused on convergent strategies. Here's the strategies that took them to the highest and the lowest. Along with its growth, they added a large amount of debt, so their equity to debt ratio kept shrinking until they failed and their earnings was abysmal. Now, let's look at question one, the trading risks LTCM exposed and hidden risks underneath. Well, they have model market liquidity and leverage risk. First, model risk. LTCM, they assumed stable means to come up with their trading strategies. The model failed to account for extreme conditions, for example, low GDP and low employment rate conditions, which could have extreme values. My teammate will talk more on this later. Second, market risk. LTCM didn't consider adverse market conditions, which could widen swap spread and go against their convergence strategy. For example, if government bond default, the yield on government bond will decrease, but the swap rate is still fixed, so the swap spread increases. Third, liquidity risk. LTCM traded exotic derivatives. They're less liquid, especially under adverse market. For example, Asian options. When a financial crisis hit, the underlying asset price could be much lower than expected, so the option might never be exercised and it becomes worthless. Therefore, nobody wants to take over these assets. Last but not least, leverage risk. We include leverage risk here. We know exactly it's not a trading risk, but it is a risk particularly for LTCM that compound the trading risk. The counterparties of LTCM contributed to the leverage risk. They allow LTCM to raise such amount of debt despite they know that LTCM lack of transparency and they didn't even fulfill a well due diligence. Now let's look at question 5. First, LTCM traded illiquid OTC derivatives. Under adverse market, they lost value. In order to get money, they had to sell these derivatives. But the counterparties took advantage of them. As they sniffed LTCM got into trouble, the anger of these counterparties driven them to go against LTCM. So when LTCM tried to sell its positions, counterparties on the other side, they're just pounding them and forced LTCM to lose more, which worsened the situation and caused nobody want to buy their products. Second, instead of diversifying its asset portfolio, LTCM didn't realize that global markets are highly correlated. They copied their strategies across geographies and asset classes. They traded one strategy with multiple counterparties and several countries worldwide. Third, under adverse market, as the value of their asset depreciated, counterparties increased their mark-to-market collateral margin costs. These collaterals were magnified by the fund's leverage and their off-balance sheet assets. As a result, LTCM's debt became unable to be paid, and all these factors add up together led to the insolvency of LTCM. Now let's tackle with question 3. My teammate Hardai will talk about risk governance structure.
Thanks, thanks, Ying, and hello, everyone. LTCM lacked control and consolidation of the trading strategies they employed, as they had no structure in place to overcome from the crisis. What I'm going to show you is opposite of what LTCM employed and what could have retained their ascendant position. The governance structure we propose is owned by the founders of the fund who establish the policies and procedures and oversee the traders, the audit, and the risk division. The way we have designed the structure, we think that the traders should be reporting to the risk division, because had the traders not been completely independent, there could have been better monitoring of the risk that the fund faced. The audit has two key roles. One, it ensures that the traders stick to the risk guidelines, and second, it ensures that all reporting is proper and accurate. Finally, in the structure, the risk management measures, monitors, and controls the risk. Just to carry out these activities, it is divided into two subdivisions: risk evaluation and model governance. I'll talk about details of these two divisions in the subsequent slides. But before we move ahead, we also think that in order to oversee the hedge funds, there should have been a third-party regulatory organization that receives the data to gauge the systematic risk that caused by the funds. Obviously, the organization has to ensure the confidentiality of the trading strategies, but the point of the idea of this regulatory organization is to highlight that the regulatory gap, although something that was external to the structure of the governance, it was very evident, and that increased the likelihood of the shock that the markets experienced when the fund collapsed. Now, our team wants to highlight the role of the risk evaluation in the structure. Risk evaluation is responsible to measure and monitor risk and has three main functions. First, it stress tests at the portfolio level for risks such as liquidity, leverage, counterparty, and correlational or market risk. And second, it assesses the ability to survive for the prolonged period of illiquidity by calculating minimum capital buffers and limit the positional market share. Third, it constantly communicates with the founders of the fund to assess the risk appetite of the fund and accordingly allocate limits to the traders. Moving on to the second division that is responsible to control the risks. So I want to highlight why model governance plays a key role in the structure. The team checks the validity and the robustness of the models. How does it do that? It basically challenges the assumptions of the risk evaluation to ensure that the risk monitoring is proper. It also triggers early warning signals to respond to the market dynamics. In the proposed structure, we realize that there is a need for expertise in the asset class in order to advise on the ongoing market risk of the various asset classes. Also, any new strategy or sizable trade must be assessed by the model governance and subsequently require approval from the senior management. After designing the risk governance structure, we thought through to find out what could be the potential conflicts and how they should have been managed. First, a potential conflict due to over-dependence on the insufficient models, such as just depending upon the short-term historical averages or volatility's normal distribution. This is prevented by model governance team that challenges the model assumptions and ensures that the asset behaviors are not misjudged. Second, a conflict where traders break the risk management's guidelines. The proposed structure will limit the trader's discretion of selecting the securities, as the audit has the authority to restrict the trader's exposures. Now, there will be funds where founders are the traders, which was the case with LTCM as well. But the founders have to ensure that they themselves stick to the guidelines and discuss within themselves of any deviations to those guidelines. In conclusion, sorry, I missed the third point. Finally, a situation where traders blindly use the trading strategies or asset classes. This conflict is managed by risk evaluation that assesses every new strategy and model governance that through its asset class expert ensures that all relevant risks are accounted for. In conclusion, this structure will come with a cost, but we think that the money is well spent for a fund as big as LTCM was to be afloat at the time of crisis that we are currently going through. Now we move on to the stress test part of our presentation, where my teammate Xiang will mostly cover the second question in the executive summary.
Thank you, Hriday. As my teammates mentioned, there are 4 types of risks that we think apply to most of the trades that LTCM had. Model risk, market risk, illiquidity risk, and volatility risk. We'll talk about how they're relevant to specific trades on this slide, and then we'll move on to specific measures of them over the next 2 slides. First, market risk. It can manifest in 3 ways. Some trades are purely directional. According to an SEC report, LTCM had about 500 million stakes in equity in 1998. These trades are clearly not market neutral. And even for the trades that are designed to be market neutral, they're only so in theory, because hedging can never be perfect. Like the shorting volatility trade they did on French equity index, under high volatility, a price fluctuation in both directions can cause the trade to lose a good amount of money. And for fixed income trades that bet on spreads, we think that spreads themselves can be correlated with benchmark interest rates. For example, a rate cut may come with a stimulus package, which may help restore the credit market's confidence and narrow the corporate bond spreads in general. So in that way, they're correlated through macro events. And then there's liquidity risk. Many of the instruments LTCM used had very limited active trading. Like the swaps they used in swap spreads, in 1998, SEF was still not established. Or the employee stock options they sold to UBS. Depending on the market condition, there might be a high liquidity premium when trying to close these positions. And then there's volatility. Besides the direct shorting of volatility, an extraordinary volatility level can lead to a general flight to liquidity, which is basically what happened in 1998. And lastly, there is the model risk. We think that general economic, macroeconomic factors also matter as the inputs for the model. We think they affect the conditional distribution of other risk factors and also the correlation between them. For example, say with low GDP growth, high unemployment, low consumer confidence, it's likely we have an underperforming stock market, and also for stocks that have disruptive technology, they probably have low trading volume and high volatility. In the actual stress test, we want to do 3 things. First, we regress the asset's price, market, and volatility risk factors. And then we construct the bid-ask spread using liquidity factors. And lastly, we'll generate a prediction for the asset under distress using a set of distress risk factors. These distressed risk factors will come from a copula where the correlation parameter will be modeled through macroeconomic variables. Moving on to specific benchmarks for each risk. For market risk, we use S&P 500 and Russell 3000 to cover the equity part. For debt, we use 10-year treasury yield as the baseline interest, and also 2 indices that reflect the low credit risk sectors that LTCM was most involved in. For liquidity, there is no existing benchmarks, so we get creative and we look into past academic works. We think there can be 3 metrics. First is the relative bid-ask spread, which is the normalized version of the bid-ask spread. Second is the market efficiency coefficient, defined as the long-term return variance divided by this timescale short-term variance. Basically, a ratio below 1 would mean that the short-term variance exceeds the long-term average. So the asset might jump around within a day, which could be a signal for low liquidity. Also, the Hui-Hubel liquidity ratio, which measures how much trade occurs for every incremental price movement. Ideally, for liquid assets, a large volume can be cleared without affecting the price too much. For volatility, we use VIX to capture the implied volatility on equity index. And then for specific assets, we also calculate its average true range so that we can have asset-specific attributes. Stress test will help expose the potential weakness in the fund's asset, but not the fund's liability. LTCM collapsed not just because its asset value shrunk, but also because its counterparties pulled back the financing and issued more margin calls. How does the counterparty structure affect the fund's financing? My teammate Sai will cover that.
Thank you, Shiyang. LTCM's complex and overextended counterparty structure fundamentally increased LTCM's credit and leverage risk, as well as their counterparty systemic risk. Bear Stearns' role was clearing a lot of trades for LTCM. LTCM also wanted to preserve secrecy with counterparties regarding its trading strategies. If they wanted to trade a short equity volatility position, they would split the two legs of the position with different counterparties. For example, if you look at the green text, they shorted the S&P 500 calls with Merrill Lynch and the puts with Lehman Brothers. This secrecy is why there are no direct arrows between LTCM and the counterparties. This made it hard for LTCM to measure its aggregate risks. When closing positions, they would make offsetting trades. This exposed LTCM to significant cross-default risk. If one trade defaulted, this would lead to a cascading domino effect that affected all trades. LTCM also maintained significant leverage risk through this structure. Not only did LTCM use Bear Stearns as its primary line of credit, they also obtained financing from its counterparties. This resulted in significant leverage because LTCM did not need much of their own equity for each trade. This was also aggravated by the lack of due diligence by counterparties. Trust in LTCM's reputation led to lax collateral requirements for LTCM. For nearly $3.3 billion in assets traded on this slide, only $1 billion would have been collateralized. When the crisis hit, counterparties feared the risk of holding insufficient collateral. They hiked collateral requirements significantly, in this case, $600 million. Not having the $600 million in capital would become a problem. Had LTCM traded in a formalized central clearinghouse like the swap execution facilities created in Dodd-Frank, LTCM would have bore significantly less risk. Instead of Bear Stearns clearing trades directly with the counterparties, the clearinghouse would become the ultimate counterparty for all trades. This shifts much of the counterparty credit risk and liquidity risk to the clearinghouse instead of staying with LTCM. For example, SCFs enforce standard mark-to-market collaterals. Instead of the $1 billion in collateral originally held, the $1.6 billion in collateral required would already be held by the clearinghouse. This would have eliminated the $600 million liquidity shock that LTCM faced. Furthermore, the cross-default risk from the offsetting trades would be eliminated by multilateral derivatives netting. By offsetting trades, LTCM's positions would be effectively closed. The only remaining risk that LTCM would have had would be the leverage risk from unpaid margins and indirect risk to the assets from the mark-to-market practices and the underlying spreads. Finally, the transparency that formal clearinghouses provide reduce systemic risks by giving a way for constituents and third parties to assess and regulate aggregate risk exposures. In the real world, the enforcement of standard collateral practices and multilateral derivatives netting would have reduced LTCM's capital inadequacy issues. This case was extremely enlightening with regards to practical applications of risk management. We were able to learn about the realities of risk modeling, that no matter how sophisticated your models or how intelligent you are, the market isn't always efficient or rational. You must still monitor the economic risk factors to prepare for those tail risks. We also learned about the importance of regulation like SCFs and OTC derivatives markets and transparency to reduce the systemic risk that funds can hold. Finally, the importance of a strong risk governance structure cannot be understated. It is absolutely important for funds and banks alike to have effective risk communication, reporting, and monitoring to prevent unnecessary risks. We are honored to be given this opportunity by PRMIA, and I want to thank you all again for your time.
Thank you very much. It was a great presentation. Any questions from the judges?
Yeah, let's just make sure you have the judges unmuted.
Yeah, I think everybody should be able to unmute themselves right now.
Okay.
Do you have a question or?
No, I just wanted to make sure.
Yeah. Yeah. Okay. I'll go first then. You mentioned it was a solvency crisis more than a liquidity crisis. If there is a solvency crisis, there's usually a liquidity crisis involved as well. Why do you think the bailed out portfolio made a small profit if it was an actual if this was a solvency crisis? How do you motivate your rationale around that?
So when LTCM was at its lows was when the bailout happened. So when all their assets were already at their lows, if you hold on to them for a longer period of time, like these assets happened, you're going to gain profits. Like you see it now with like stocks like Apple and Amazon that got hit significantly during the coronavirus time, and now they've surged 24-25% during the recovery. So like there is going to be some, like, this was a significant effect that significantly like dropped the value of these assets. So it's effectively like buying the assets at a low price for these banks when the bailout happened, that the profits eventually came out.
Just to add on to that, they depended upon the convergence of the spreads, but they depended just that they thought that the spreads would converge in a short term, but then it had to converge at some point in time. But then in 1998, it took a lot of time to converge, and that's why the profits came in at the last after a point. But till then, the situation was out of control and it couldn't survive through that period of time.
Thank you.
Do we have any other questions from the judges?
I had a follow-up question on the governance side. If you could go back to your model validation slide, you're showing there a reporting structure that goes back into the fund founders. Next one, I think, yeah. How do you consider this relationship between the fund founders and the risk management division and the audit team?
So the structure we have made is the audit and the risk management reports to the founders, but the audit team also reviews the risk management division to ensure that the reporting is accurately done. And the risk management constantly has a feedback loop with the founders to assess the risk appetites and to gauge the risk and communicate those risks to the founders. So the founders are the true at the top of the hierarchy, overseeing the risk and the audit. But then there is a relationship between the audit and the risk management as well.
Yeah, in a way, I think it was the founders in this case that took too much risk. So do you think there would have been maybe a better reporting structure here?
Actually, quickly before he answers,
Yeah.
our presenter Adam, he has to be unmuted by the host. He's currently muted. So sorry.
There's something weird happening with this Zoom. Apologies. Adam, you're unmuted now.
Is he? I don't know.
He's still showing up as being muted on mine.
Yeah, he shows up as muted.
I think you unmuted the wrong Adam.
It's Xiang. He changed his name to his official roster name, which is Xiang Ni. So, sorry about
can you help me spell that?
SHIYANG.
All right. Okay, got it. Thank you.
Okay, cool. Cool. Sorry about that. Could you Peter Peter Chovanec is also muted apparently.
Thank you. I've been trying to. Okay, there you go. Peter, you're also live.
Okay, thanks.
Could you actually repeat your question now?
Yeah.
Sorry
so,
about that.
yeah, do you think there'd be a better reporting structure here than to the founders, and maybe there's a different committee or a different body that should supervise that, or would you stick to the founders as a reporting?
So we think that the reporting has to go at some point in time to the top of the hierarchy. So we can put like a chief risk officer in the between, but then that should be the part of the founders. Like so, in the end, we think that we believe that the founders need to take some risk at that level, because otherwise the trading strategy, and it would be very difficult to conduct business in that case if founders have like no say at all. Otherwise, the risk has to have some say, but then founders also need to say to carry on the business. So
And
that's
to add on to his point, the audit team's specific job and with relationship with the risk management is to ensure like proper, like for example, audit team makes sure compliance of risk guidelines for traders, whereas with the risk management division, they're making sure that there's proper and effective reporting coming out of the risk management division. So there's also controls there to ensure that there's proper reporting.
We're also worried that if there is an external team that knows the details of the trades, there will be a conflict of interest. And then I don't think any fund would be willing to do that. For risks, like that's why like for the external regulators, the only information necessary for them was to ensure that the systemic risk is taken care of. But as far as what's going on inside the fund, we think it's better monitored within the fund.
Thank you.